This is joint work with Jianqi Hu, who is an accounting professor, most recently at Kellogg at Northwestern, and she's moving to China. So she's in the process of that move right now. And Xiaoyan Zhang, who I've written with on several occasions, who is also in China at the moment. She's at Tsinghua University. But I met her when she was still a student at Columbia. So we started writing together then. So I'm happy to have her. This title of this paper is called When to Inform Short Sellers Trade. And we're going to try to link up intraday data on short selling with some theoretical models of informed trading to try to draw some parallels and distinctions and connections between those two things. We're also looking at some fundamental data here. So basically 3 different sources of data to help us say something about the activities of short sellers. So what do we know about short sellers? We know that they help make stock prices more efficient by incorporating negative information into share prices. And this has basically been a literature now for about 20 years, where it's been a substantial literature. And what we know about that is that basically heavy shorting leads to lower share price and is associated with future worse firm fundamentals. And there's little evidence of price reversals after price declines. So it seems like they're not manipulating prices, but they're likely to be informed. One of the things that we did in our recent 2020 paper is basically look at 3 sources of fundamental information: earnings announcements, analyst recommendation changes on the stock, and analyst forecast revisions. So we found that all 3 of those things were important and explained about a quarter of the profits that the outperformance alphas that short sellers could have earned. So fundamental information seemed to be important, but obviously not everything, left a lot of room for other things. And what we don't know is basically how heterogeneous short sellers time their trades, particularly within the day. And we're going to try and say something about that, and say something about what that implies for the differences in the nature of information among short sellers. So let me say a word about what we know from the theoretical literature on informed trading. And I think of this as basically 2 different sort of classes of models, and they're obviously different. Researchers have contributed to these models in different ways, but I lump them into two big groups. So there's sort of the steady trading hypothesis that goes back to Kyle 85, which says that a monopolist informed trader who knows exactly when the information is going to be fully released, but is the only one with that information, is basically going to act as a monopolist, as a dynamic monopolist, and do steady trading over time, slowly releasing that information into the market and incorporating that information into prices. And that contrasts with the decreasing aggressiveness over time hypothesis, which I think of as basically characterized by 2 different sets of authors for the most part. Foster and Vishwanathan. Basically, there's a signal that's released while the market is closed, and informed traders basically trade more aggressively early on and less aggressively afterwards. And in a related vein is Holden and Subramaniam, 92, which is basically that competing informed traders receive the same signal of value, and basically they trade very aggressively in the first few rounds of trading and less so afterwards. So a lot of information is incorporated into price quickly, and then basically a little leftover information is incorporated after that. There are a few other papers along the same lines that are also relevant, but I think of Foster and Vishwanathan and Holden and Subramaniam as sort of the canonical papers in that sort of decreasing aggressiveness over time hypothesis. So we're going to try and say something about whether the data is consistent with one or the others of these, or is consistent with both, and whether it's consistent with both at different times. So what we actually are looking at, we're basically, we have intraday data, and so we can look closely at a set of US short sellers throughout the course of the trading day, and whether they concentrate at certain times of the day, and whether they have information that's different, whether it's short-lived or long-lived, and whether they trade at different times of the day based on that. And we have some data that separates institutional short sellers from retail short sellers. And so we want to say something about whether those 2 different types of short sellers trade differently in general. So what do we think our contributions are? Well, there are very few existing papers that examine intraday shorting data. So relative to the existing literature, we think this is the first paper to say something about the information content of short sales during various parts of the trading day. And basically, we can test distinct and often competing hypotheses of various informed trading models using this data. And we also characterize some of the private information that shorts have. So just like we did in that earlier paper, we're going to say what we're going to ask ourselves whether we can distinguish between fundamental info like earnings announcements, analyst recommendation changes, and analyst forecast revisions, and say something about whether these shorts get that news early and are basically get some private signal of that news before it's released to the public. And also the other thing that has showed up in the literature is that maybe short sellers are good information processors. So they don't get the information early, but they basically are good at processing publicly announced fundamental news. And it's that quick processing or good processing that contributes to their potential alpha. And basically, this could be useful to short sellers. This could be useful to regulators. It could also be useful to basically sort of anybody who's involved in short selling in any sort of way. So, so we think there's lots of applications of the results here. Our main data source on this is from the CBOE. The CBOE, you may or may not know, runs 4 different exchanges: the old direct edge exchanges and the old BATS exchanges. So they all have slightly different rules and rebate structures and things like that. And so basically they have 4 different exchanges, and basically they release, the reason we're using them is they have great data on short sales on their markets. So basically the same information as what's in the TAC consolidated trade files is published overnight on the CBOE website, and it's totally available for free. So we basically get that data, and the data are basically, it's the same data as the TAC data, but it tells you whether there's a short seller involved. So that's really the main reason we want to use it. And we think that may be very useful because there's some evidence that the informed traders who value immediacy may be wanting to trade on exchange because they want to trade fairly urgently and get their information, get their trades done quickly. And it may be easier to do that on exchange. So, but I have to say that the real reason that we're using that data is that it's available right away and it's available for free. So availability of data is not to be underestimated in a field of study like this. So to that data, we're adding data from FINRA, which is basically the same information as CBOE for all off-exchange transactions that are reported to a trade reporting facility or TRF. The main thing that's different about the data from FINRA is that there's a big reporting lag for the data from FINRA. It can be up to 45 days. It's basically published by the middle of the following month, by the middle of the following calendar month. So, so it might be that some informed traders prefer that opacity, the long reporting lag, and prefer the fact that if you're trading off exchange, perhaps you would have lower costs from trading off exchange. And so that might attract certain informed traders. So we're not quite sure exactly what our prior should be on this, but we're going to look at the data, and the data is going to tell us something about that. The other sorts of data is earnings and analyst data from IBIS. And so we have earnings announcements, forecast revisions, and recommendation changes on the stock. And basically, like I said before, we're going to see whether they get these signals early or whether it's just that everybody gets the signal at the same time, but the short sellers are very good at processing that publicly available information. And the main reason that we're using the FINRA data, in addition to basically investigating a little bit about opacity and whether that opacity is important to short sellers, is that the main thing about the FINRA data is that we can separate retail and institutional orders using an algorithm that we wrote about in Bomer Jones, Zhang and Zhang, published last year, which we actually affectionately call BJAS, BJZZ, BJAS. So I don't know why we called it that, but we did. So anyway, and it turns out that we basically are just using a sub-penny algorithm so that anything that's executing at sub-penny prices is probably that's not at a midpoint is probably a retail order. So the idea here is that anything that's not at a midpoint, not at a full round penny or at a half penny, is almost surely a retail order that's being price improved by an internalizer or a wholesaler of some sort. So that's the idea here. And that's the idea of this algorithm, and it seems to work very, very well. We actually are able to sign the trades, and we actually did some checks with some NASDAQ data in that other paper to see whether we got the buy-sell directions right for the things that we identified as retail orders. And we basically got it right 98% of the time. There was only a 2% error rate in signing these retail identified trades. So anything that's at a half penny price or at a round penny price, we're going to call a proxy for institutional order flow. We think there's going to be some error in terms of what gets assigned to which category, in that we're almost sure that everything, because of Reg NMS, everything at a sub penny price that's not a midpoint price, not at a round penny or a half penny, is almost surely retail, but the converse is not necessarily true. Things that are round penny and half penny prices could be improved by large amounts or not improved at all. They could be improved by half a penny or by a round penny or 0 pennies. So we think that that probably also includes some retail order flow, but we're pretty confident that everything that we call retail is in fact retail. And everything we identify as retail is in fact retail. So how does this work? Basically, if you're below the half penny, you're a seller initiated transaction that's been price improved by a fraction of a penny. And if you're very close to the penny, but just below a round penny, it's probably a buyer initiated transaction that's been price improved by a small fraction of a penny. So and then we have a bunch that we don't assign to the retail category, and anything that's not assigned to the retail category is likely to involve an institution instead. Then we basically cross-match all this stuff to CRSP, basically using CUSIPs and ticker symbols. We keep only common stocks, and we basically require a minimum share price greater than $1 per share. That's because if you're below $1 per share, then the minimum tick size changes dramatically. And so you can't use our sub-penny algorithm to separate retail and institutional order flow. Our data is from 2015 through 2019, and there's a wrinkle in that we have to handle. Basically, there was a tick size pilot in the middle of this period for about 2 years, from 2016 to 2018. Basically, the minimum tick size was widened for smaller cap stocks. And so they picked a bunch of stocks and basically assigned about a third of them to be controls, and they assigned other ones to be in 3 different treatment groups. So what we do is basically we exclude all the treatment stocks during this pilot period. So it shrinks our sample a little bit, but shrinks our sample by about a third. But what it means is that none of our stocks actually experience a tick size change during this time period. So we feel pretty comfortable about that approach. So what are our variables that we are using here? Well, we're basically what we're measuring is shorting flow, not short interest. So we can tell when a short sale actually happens, but not when it's covered, not when the position is closed, and we don't actually measure the stock of open short positions at any point in time. So it's important to remember that we do have a lot of insight into shorting activity, particularly shorting flow measures, but not the stock of outstanding short sales in any way, shape, or form. So we basically then divide things into 3 different buckets. Most of the paper basically distinguishes between short sales near the open, so within a half hour of the 9:30 open in New York, and then short sales in the middle of the day, anything between 10 o'clock and 3:30 in the afternoon is called midday shorting. And then there's shorting at the close, shorting in the last half hour of continuous trading, just before the final auction that closes trading for the day. And then basically that's as far as we can get with the SIBO data, because we don't have any indication of what kind of trader is behind that SIBO short sale. But in the FINRA short sales, we can distinguish between retail sales, retail buys, where the short seller is on the other side, is on the is supplying liquidity rather than demanding it. That's probably a market maker who is basically short selling in order to accommodate the buying interest of a retail trader. And then there's the institutional suffix for things that we don't assign to the retail category. So that's basically what we do. We try to basically trade off precise timing with useful buckets that tell us something about when the trade is occurring during the day without putting too much complexity into the calculations that we're doing. And just to tell you, shorting is quite common. So during our sample, it's about 44% of off-exchange trading in total. And then the CBOE trades here are basically calculated relative to their trading volume, relative to actually all the trading volume, consolidated trading volume in the markets. And basically, their trading accounts for something like 16% of all trading. So those are just a few summary statistics for people to sort of understand what's going on. And just a few more summary statistics are these different categories for FINRA trading. Basically tells you something about how much is happening in the institutional bucket, how much is happening in the retail seller initiated bucket, and how much is happening in the buyer initiated retail bucket. So again, it's basically all those things are going to add to that 44% total volume that is basically how common is shorting relative to total off-exchange volume. How much is shorting off-exchange relative to all trading off-exchange. So just a couple more things. There's the standard U-shaped shape on this, which is in all of these things, there's a huge increase in the last half hour of trading. So there's a lot of shorting in that last half hour of trading. And there's a similar sort of U-shape for the stuff that's on FINRA versus the stuff that's on the CBOE exchanges. But again, you see very much the same sort of standard shape. What's amazing to me is that it's not really much of a U, it's more of it's like the volatility smirk that people find in option pricing. There's a huge amount in the last half hour, but not such a huge amount in the first half hour of trading in terms of shorting. So, and we're also doing some stuff to show you that these are pretty much stationary over time. So there are huge time series patterns that we need to take into account for, or non-stationarities that we need to worry about. But it's pretty straightforward to think about this as one stationary sample. So we're actually trying to figure out here sort of the cross-sectional informativeness of shorts. So we're thinking about our heavily shorted stocks today, the ones that underperform a lot tomorrow or in the future. And so that's basically, we're trying to see whether these shorting variables predict the cross-section of returns either the next day or several days into the future or several weeks into the future. So we standardize that right-hand side variable and add some standard control variables on this to basically have a standardized shorting variable that basically is going between 0 and 100. So we think of that as basically standardized between 0 and 1 in terms of the heaviness of shorting. And then basically we're going to see whether that predicts the future cross-section of returns. And so again, basically, so what do we find? So we'll start with the CBOE results because these are the on-exchange short sales, and we see whether these predict the next day of returns. So, so basically the question here is, are short sales at different times of the day differentially informed about the future course of stock returns? And the answer is yes. So, so for trades on the 4 CBOE exchanges, trades at all 3 times of the day seem to predict future returns. So heavily shorted stocks basically have, so if you move through the entire cross-section of the distribution of shorting, you basically are going to find that returns the next day are on the order of 9 basis points lower. So these are measured in basis points. So that may not seem like a lot, but 9 basis points in a day adds up over the course of a year. We'll see if I'm not going to even try to do that calculation in front of you here because my arithmetic is not that good these days. So the thing is that the most informative shorts are near the early part of the day, the open, or the middle of the day. And the ones at the end of the day are the least informed about what is going to happen on the next day. And to contrast that with the FINRA results, the results for trading on exchange are much stronger than the results for trading off exchange. I mean, now there are some things that are significant in the FINRA data, in the FINRA off-exchange shorted data, but the magnitudes are much smaller and the t-stats are much smaller on these. Opening trades near the open are still somewhat informed, but the coefficients get smaller for trades in the middle of the day, and in fact, the coefficients have the wrong signs for short sales late in the day. So that is pretty interesting. We think that what that means is that basically is in support for this paper by Reed, Samedi, and Sakobin basically say that the most informed short sales are happening on exchange because they're the ones who need to trade urgently to make sure that they get their trades done and to make sure that they're able to earn the alpha that their models say that they should be able to earn. So that's a very interesting, we think, empirical regularity in the data. So this is really just a time series, another way of showing to you that we think this is a stationary time series and we don't have to think about subperiods or anything like that. So if we look at longer horizons, basically we still find a significant results for longer horizon results, particularly for the on-exchange short sales. And so if you look here, basically short sales at the open or the middle, if you look out even like 6 weeks or so, those are still significant. So, short sales on these CBOE exchanges seem to predict the cross-section of returns out several weeks. So some of these things are even significant out 11 and 12 weeks. So we don't quite know exactly why they should be significant at these long horizons. We haven't done too much to basically line that up with particular information releases, but it's interesting to note that at these kinds of horizons, 10 to 12 weeks, that lines up with a quarterly earnings cycle. So we think those two might be closely linked, but we don't have hard evidence on that. I will show you some hard evidence on what kind of information they do seem to have at shorter horizons. So, and the FINRA results, just so you know, are pretty modest at multiple days, but they do then turn significant at longer horizons. So if we're talking about 5, 6, 7, 8 weeks, then you get stuff that is significant, certainly for short sales near the open or short sales in the middle of the trading day. With the FINRA data, like I said, we can basically separate retail and institutional shorting. And basically what we find there is that institutions are in fact more informed than retail short sellers. And so that you can see here, at least the short-term results here are quite significant. So one day predictability is quite significant, and even several weeks out, there's still some predictability, especially for short sales near the open and short sales in the middle of the day.
Also about 5 minutes.
Okay, thank you. So if we're thinking about retail sales, it's not nearly so significant for most of the time, but there are some weeks that do show some significance. So it says that that on FINRA, some retail sales are in fact quite informed. And if I predict intraday returns, I also get very strong predictability for sales early in the day and much less predictability for short sales that are late in the day. So there's a monotonically decreasing sort of coefficient and t-stat as you go through the day. So again, it appears that short sales early in the day are a lot more informed than short sales later in the day. So if I interpret this, basically it seems like the strongest predictability is for stuff that's near the open. And these are consistent with the models that say you have decreasing aggressiveness over time, like Holden and Subramanian, or Foster and Vishwanathan, where a lot of short sellers are competing with each other, and basically most of their private information is incorporated into price pretty early once trading reopens. The underlying assumption here is that these guys get a signal of value while the market is closed, and they basically trade as soon as they can. And basically for short sales near the open and in the middle of the day, at longer horizons, basically it appears that those trades are informed basically all throughout the day. So this is more consistent with a steady trading model like the dynamic version of Kyle. And so we think that we've got evidence depending on the evidence you look at, it either supports the decreasing aggressiveness or the steady trading model of Kyle. Now, the last thing we do is basically look at earnings news and whether they're able to anticipate bad earnings news and they're able to short sell in front of that, or whether they are able to process news quickly and basically trade on that bad news right after it comes out. So we basically look to see whether they're trading in front of the announcement of this bad news, or whether they're trading after the announcement of this bad news and they just manage to process it pretty quickly. So we find some evidence of both of those. There's evidence that they're doing both of those things. They're able to be in front of bad news, and they're also able to trade after this bad news is released. So we find both of those seem to be associated with returns for short sellers. The only thing I will say here is that some of the results we have are not significant, particularly for trading on FINRA. So again, it seems like the important information, if you've got important information, you might trade on it right away, and you might want to trade on exchange just to make sure you get your positions in place in time. So that's basically what we have. So let me conclude before I totally run out of time, which is basically we're looking at 5 years of a whole bunch of US exchanges, 4 different exchanges, and a bunch of off-exchange trading by these short sellers. And we basically find that trading near the open and trading during the middle of the day strongly negatively predicts the cross-section of returns at daily horizon and up to 12 weeks ahead. Basically, short sales near the close only seem to be informative at next day horizon. So you would only trade near the close if you had short horizon information. And so basically we find some support depending on what we're exactly looking at for aggressive trading, basically a model like Holden and Subramanian, and basically long-term predictabilities seems to be consistent more with the dynamic model of Kyle 85. So basically the other last conclusion to think of is basically we line this up with firm fundamental news or firm fundamental events, and basically shorts at the open basically both anticipate this future news and react to just recently released fundamental news. So we have some evidence for both sort of channels here, and we think it's interesting that we have evidence for both of those channels, and we don't have it that one seems to dominate the other. So that's where we are, and I will stop there, Albert, and turn it back over to you.
Thanks a lot, Charles, and it's magnificently on time. I'd like to introduce Kumar Venkataraman. At the same time, thank him for participating in this conference and share his views on this work with us.
Can you turn on my screen sharing, please?
I can see your, oh yeah, wait a minute. I think Charles, you need
Charles
to
is still on.
unshare. Let's wait for Charles to unshare and then you can share your screen.
Okay.
I'm done. So
yes.
Now you should be able to. Excellent.
Can you see my screen?
I can.
Okay, excellent. Well, thank you very much for this invitation. Thanks to Charles, Terry, Albert, and Christine for organizing this conference. Hopefully next year or in the spring, we will.
Yes, we certainly hope so.
Will be. So short. This paper is about informed short selling, and this paper presents new evidence on the intraday short selling patterns based on data from CBOE and FINRA. And in terms of the design of the paper, the key question is, how do you identify informed short sellers, because they're not flagged in the data? And so the empirical approach of the study is to look at the shorting flows and to look at the association between shorting flows and future returns. And to the extent that the shorting flow that is observed is informed, then it would correspond with the ability to predict lower returns in the future. So this particular approach, which has been used by Charles and co-authors in many of their other papers, can then be, in the context of this intraday data, can then be looked at by looking at periods within the day, for example, near the open, midday, near the close, on exchange versus off exchange. And this is the data from CBOE and FINRA that Charles talked about, as well as for off exchange traders, classify them into trader types, retail versus institutional, using the Bomar et al. Bazang algorithm that Charles just talked about. So the interpretation of the results in the paper, the structure provided by theoretical models really guides the interpretation, and in particular, the theory surrounding trading strategies of informed traders. So the main results, very quickly, short sales near the open and at midday anticipate future returns, both on and off the exchange for retail as well as institutional if it's off exchange, both short-term and long-term. But as Charles pointed out, the economic significance is much higher in the case of on exchange than off exchange, consistent with immediacy on an exchange. Short sales near the close anticipate short-term returns, but not long-term returns. And looking more closely, it's the retail shorts that are informed, but informed shorts are not, which is consistent with liquidity and rebalancing needs of institutions as they trade closer towards the close of the day. In terms of earnings releases, the study finds evidence consistent with both processing ability of informed short sellers. For example, both the CBOE and FINRA institutional shorts react very quickly to a news that has been made, as well as the forecasting ability of short sellers, that is relating the shorting activity in anticipation of bad news in earnings releases. So in terms of my comments, this is a very interesting paper. As Charles said, this is the first look at intraday analysis to show the relationship between when informed shorts are trading, where they are trading, etc. My main comments, I would put them in two categories. First, it relates to some ideas on how perhaps the informed shorts can be identified a little bit more precisely. So I have a suggestion on a slight modification to their existing approach, as well as research design and alternate, different research design that may allow them to directly identify informed shorting. And then I have also some ideas on how their empirical tests can more closely align with theoretical predictions. And there are some really nice theoretical papers, as you know, on the horizon of informed traders, short horizon versus long horizon, on the competition among informed traders and how they trade. And so I have some thoughts on perhaps how that can be further refined. So let me first begin with my first suggestion, which is modification to the existing approach. So the existing approach here, it can be understood by looking at this regression from Bomar, Jones, and Zhang. You have the shorting activity at time t being associated to returns in the future, along with some control variables. And to the extent that this shorting represents informed flow, the informed shorting should predict the future return. So the coefficient of beta 1 is the focus of the analysis. And in terms of the shorting variable itself, instead of looking at the shorting flow, the shorting flow in the cross-section is ranked from 1 to 100 by putting them into 100 groups based on the level of shorting flow. And this rank variable is the one that is used in the regression. So my recommendation on a modification to the shorting measure comes from the following observation, which is that the shorting flow that we observe in the data is made up of two types broadly, arbitrage shorts and informed shorts. And arbitrage shorts, for example, are participants engaging in convertible arbitrage, merger arbitrage, index arbitrage, etc. And Charles, in his earlier work, Bomar, Jones, and Zhang, for example, point out that about 25% of the shorting can actually be attributed to like program trades. Similarly, Mitchell, Pulvino, and Stafford in their 2004 paper shows that if you look at firms that have convertible bonds outstanding or are part of a merger, the arbitrage shorting is actually more important than value-related shorting. So my hypothesis is that arbitrage shorting is a large component of the shorting, and in the cross-section, shorting, the rank is likely to be persistent in the cross section. This is because arbitrage shorting is related to index membership, it's related to liquidity, borrowing costs, etc. And so the component of shorting that's coming from this arbitrages perhaps does not change that much over time. On the other hand, the informed shorting is likely to be episodic because it's going to be driven by the new information that's coming out. So in the cross section, that rank is likely to be less persistent and it's going to change over time. So this is just an idea and the authors can refine it, but perhaps one simple approach would be, instead of using the total shorting flow, perhaps subtract the average shorting flow in the stock over the last 30 days. And so this difference will then give us sort of an abnormal shorting flow, and this may be more correlated with informed shorting, and that rank or that measure can be used in the regression that they have here. So it would affect their beta 1, the statistical power of their test, and the impact of shorting on future returns. My expectation would be that the beta 1 would be larger or sort of more negative, economically larger. My second suggestion is examining unanticipated events. So right now the study is looking at earnings releases. Earnings releases are anticipated events. When I say unanticipated events, I have unscheduled news events where the timing of the event is a complete surprise. So uninformed shorts cannot anticipate the event because it's unanticipated. Informed shorts can if their information concerns the event. And so the approach would be to look at a bunch of these unscheduled, unanticipated events, and to look at the shorting flow in the days just before the event and compare it to the same firm benchmark over a 30-day period. And so if we believe that informed shorts are active closer to the event, but uninformed shorts do not change their behavior, then the delta that we observe, the abnormal shorting flow in the days -5 to -1, and then within -5 to -1, different windows during the day, near the open, midday, near the close, on exchange, off exchange, that abnormal activity may be a more direct measure of the short selling that can be attributed to informed short sellers. So patterns that may emerge from this type of analysis would also inform the results on when are informed short sellers trading. In the context of the same idea, so here are some examples of unanticipated events: earnings restatements or other types of corporate misconduct, or dividend cuts or terminations. These are some corporate events that the authors can look at. I have named a few more here, but these are the ones that come to mind in terms of unscheduled news events. My last comment relates to empirical tests of theory, as Charles pointed out. We have some really beautiful theoretical models. We have the Kyle's model, where if you're a monopolist, or if there is sufficient uncertainty on the presence of other informed shorts, then you can trade slowly during the day. But on the other hand, if there's a lot of competition, or if the information has a short horizon, then you trade more aggressively early on. So in terms of the tests of these in the context of sort of the unanticipated events, or more generally as well, variables that can pick up the competition among informed short sellers may be a useful way to sort of cut the data and to look in the cross section to see differences in trading patterns. So for example, index membership or exchange listed stock options maybe in the literature has been shown to be variables that ease short sale constraints, or data on loanable shares or data on borrowing costs would be some other ways to get at the short sale constraints. The idea is, if the short sale constraints are high, then the competition on the short side is going to be lower. But on the other hand, if the event has a large negative return, then a short seller is going to pay that higher borrowing cost and still going to go ahead and short sell. So by separating an unanticipated event into a large versus a small announcement return, one can get at the sort of the economics surrounding the competition among shorts. And then of course the time series as well, from -4 to -1 before a negative news event can be another way to get at that. So these are just some ideas on how the empirical test can be sort of made more tighter to test the theoretical prediction. So I'm out of time. So thanks again for the invitation. It's a very nice paper. First look at intraday shorting flow, and when informed short sellers trade, which venues at what times, and what traders types within the context of theoretical models on competition among informed agents. Thank you.
Thanks so much, Kumar. Well, I'm asking you to unshare your screen. I'll introduce Willem Woller. Willem is how in this country would pronounce your name. I guess you go William, Bill, or Will. Anyway, the floor is yours. Thanks also to you to be here and share your views on this topic. The screen is yours, William.
Great, thank you. Can everyone hear me and see my screen? No problems there. Great. So thanks, Charles, and the conference organizers for the opportunity to discuss your paper. All right. So as far as sort of opening thoughts, just echoing basically what Charles and Kumar already said, this paper is one of the first papers to use transaction level data on short selling. Much of the literature up to this point has focused on sort of aggregate short interest or proxies for aggregate short interest, such as the securities lending data. This paper is going to observe one side of short selling flows. There's no data on covering trades, but this sort of gives us some sense as to when short selling transactions occur and how those flows sort of evolve through time. And I think this paper tackles an important question, which is what type of an information advantage do short sellers have? Is it relatively long or short-lived? And it does this in a clever way, and that's to sort of focus on when short sellers are trading within the day and look at how persistent negative returns are after that trade. As far as a roadmap, I'll briefly summarize the paper's main findings, and then I have some sort of broad ideas of where I'd like to see the paper push a little more, primarily empirically. And then I just have some brief points about the data and some other minor points. So as far as the findings of the paper, I think we've already heard this largely, so I'll be brief, but short sales occurring at the beginning or middle of the day have predictive power of the next day, and longer horizon returns remain significantly negative. This is sort of consistent with theory where short sellers have relatively long-lived information, and trades are going to occur more gradually, so they can sort of impound that information and prices over time. Short sales occurring near the end of the day have a much smaller window of predicted power, so prediction is over a much shorter horizon. And this is sort of consistent with theory where short sellers have relatively short-lived information and have to trade more aggressively to impound that in the price before the information is revealed. And then short sellers trade aggressively near the open after bad news, but don't seem so much to trade on private information before bad news. So this is getting into sort of this information story around earnings announcements and analyst revisions. And then return results on off-exchange short sales are largely consistent with trades on exchange, except in sort of the activity around a firm's release of bad news. So especially prior to a firm's release of bad news, off-exchange shorts do tend to pick up a little bit. Where I'd like to see the paper go, sort of off the top, I was really curious as to sort of how these variables correlated with one another, as well as between off-exchange and on-exchange venues. So I think it'd be nice to sort of open things up with some correlations between the various short flow measures. I spent a lot of time wondering how these were sort of related to one another. In sort of light of Charles and I's previous work, we found some evidence in European markets of like piling on when short positions are disclosed. It's a little less obvious in this context what that mechanism would be, but perhaps there's a relationship between sort of short flow on the close of day T-1 and then open or shorting near open on day T. So I think this is one of those places where getting to one of Kumar's points, where maybe we could sort of enrich the idea that we have around what sort of the counterfactual for the amount of short selling should be. So this may be one place where we can sort of disentangle short sale informational content, i.e. sort of short sale information that gets released with a big lag, like in the FINRA tapes or in some of the NASDAQ tapes that aren't available overnight, versus sort of actual short sale or actual trading sort of induced by the revelation of the amount of short selling in the previous day. So basically short selling flow as a trading signal due to the release of those overnight CBOE tapes. So basically thinking about sort of an expected level of short flow versus the observed overnight and seeing if short selling at open loads on that difference. Next, I think over sort of the horizons that we're thinking about and thinking about how or what information these short sellers have, it might be useful to go down sort of the adjusted return path. I know this probably isn't necessarily where you want to go, but I think it's a relatively important question given how long-lived negative returns associated with short selling flow are. So you observe persistence up to a quarter after those flows. There's a paper by Jenkins, Small-Begovich, that uses the EU short position disclosure data and finds that performance is largely explained by mispricing related factors. And so I think it'd be nice to be able to sort of tie your findings to this broad mispricing if that's indeed what US short sellers are trading on. If part of their informed flow, at least around non-news related events, is picked up by these sort of mispricing factors in the literature. So maybe looking at some portfolio sorts and loading on factors to maybe gain some additional insight as to what information short sellers are trading on. And then in the information event test, I think it's not clear what the right comparison to make is. So as the way your tests are set up is basically that you're comparing firms with news on a given day, or specifically with bad news on a given day, to sort of all other firms. So firms without news, as well as firms with sort of null news, and then firms with good news. So I guess one question I have is, should we be comparing firms with bad news to firms with no news, or firms with news that sort of met expectations in some way? And so sort of the underlying idea I have here is it that short sellers are trading on like this information, or are they just trading because sort of uncertainty picks up? And obviously there may be differences between retail investors and institutional traders as far as who's trading on information versus uncertainty. But in so much as you could sort of tease that out, I think it'd be helpful. So there is some evidence in your FINRA results that short sellers are sort of active around all bad news, both before and after. And so I think some of that front running, just given the magnitude, may be more indicative of sort of trading on the anticipation of a news event coming out. Again, getting back to sort of Kumar's point. So I think a natural way to answer this question is to look at the other side. So just look at basically good news and see if all the signs flip, or if you see big time short selling around good news events that would be sort of more in line with this anticipated news or uncertainty around news. Another point, I have colleagues here at Tulane that sort of argued that information traditionally contained in earnings announcements is now mostly revealed through 8K reports. And that's especially post 2004 with a regulation change. I think this again gets back to Kumar's point about sort of unanticipated versus anticipated news. So do your results hold around these 8K filing days? It may just be the case that sort of short sellers are better at taking that information in 8Ks and predicting what analyst recommendations or earnings will be going forward. Brief points about the data to wrap up. Sort of, it wasn't clear to me why your sample started in 2015, since these short sale tapes are available at least since 2010. Also, sort of a couple of the NASDAQ exchanges have free information. I assume this is small, but I think it bears mentioning why you exclude that data from your sample. And then sort of this is something that was largely cleared up between the version of the paper I saw and the version that was presented. So I'll leave it in here for Charles to read when I send him the slides, but I'll skip it for the sake of time. Last thing, just about the FINRA data, I was wondering to the extent that you could sort of break institutional trades up by assigning them according to some algorithm like Lee and Reddy. It might be difficult, but I think really the comparison that you want to make is short sales involving retail sellers versus short sales involving non-retail sellers. So the way that the data is sort of partitioned currently doesn't allow for that comparison. But I think I'm basically out of time. So thanks again, and we'll leave it at that.
Thanks a lot, Willem, for sharing your views. Before I ask Charles to give a brief response, I'd like to invite people to simply, unmute yourself and start video to chime in if you want to contribute to the discussion.
Charles,
Hi, Paolo.
how are you?
Good, thanks. How are you?
I'm doing great. Thanks for asking. So I wanted to ask you a quick question, and perhaps your answer will be related to the type of data that you have available, like the theoretical work that you cited to motivate the paper, the Foster and Vishwanathan, Alden and Subramanian papers always refer to the type of information that the speculators have in explaining whether they would want to trade sooner rather than later. And so if the speculators have homogeneous information, they want to do a rat race and trade as soon as possible. If they have heterogeneous information, they'll do a waiting game and wait to trade as late as possible because they want others to reveal the information. And so the question is whether there is anything in your sample related to the short sellers themselves or some state variable that you could think about that could capture the extent to which the negative views that these people have are somehow heterogeneous. And conditional upon that state variable, you might pick up that the short sellers prefer to trade later versus trading earlier. So it's less about whether this is long-lived information or not, but more about within the subset of short sellers, whether the information is homogeneous or heterogeneous.
Thanks, Paolo. That's a good question to ask. And I'm not sure I know the answer without putting pen to paper and actually deriving some equations. But it strikes me that that you're exactly right, as long as there's zero correlation between the signals, then it's purely heterogeneous. And those results about weighting would certainly be true. What I'm not so sure about is what happens if there is a common component and if there is a heterogeneous, uncorrelated orthogonal component that is investor specific. And there it strikes me that basically there may be a rat race on the common component, and you may have this weighting effect on the idiosyncratic component. So, but that's just a suspicion about what I would find. But I think I agree with you. I think it's well worth doing.
Others?
Hey, Charles, it's Greg.
Hey, Greg.
One thing to, and I don't know to the extent that this would actually influence any of the findings, which I actually found quite interesting. But I think as was put up on the chat, the data that you're using, the real-time data, this is regulatory definitions of short, which are likely to be very different from the economic definition of short that one would expect it to be. So you're going to find a pretty significant bias in the number of trades that are both reported on the CBO data, as well as the FINRA data that are marked as short, that you would not have considered short for the purposes of the study that you're doing. So that ranges from riskless principal transactions, where you may have a market participant who buys something long, the market maker, the intermediary is flat, does riskless principal, simply flips it back to the client. That generates a short message, both on the FINRA TRF as well as the exchanges. The SEC also, as part of its Reg Show rollout back in 2008, defined a short based on the number of orders that you have outstanding. Whether or not you actually ever go short a stock is independent of whether or not the order is actually marked. A lot of it has to do with the number of orders that are in the market at a given time. That tends to also overestimate. And there's other smaller things that overestimate. So directionally, more shorts is different from less shorts, but there's also some confounding factors where it might be that in a news situation where there's positive news and there's market market participants are somewhat neutral, but you have a lot of people who are actually going long, you may in fact find that there will be more short selling, even though no one has actually gone short during that period of time.
Thanks, Greg. I agree with you that actually these definitions really do matter. So, because they can affect a large fraction of the volume we're talking about here. So it's something to look into. All I will say in our defense is that this is the data we have, and also that a lot of those things that you talked about might be marked as short exempt. So if they're short exempt, they will still appear as short, but they're qualitatively somewhat different. So we could distinguish between those two types of shorts and see if there's anything important in that distinction.
Yeah, so taking out the short exempt certainly helps. It's short exempt really only applies to circuit breaker stocks that have moved a lot, but that would be a good filter to at least take out some of these.
Thank you. Yeah, awesome.
Others? Thanks for coming in, guys. This is so important for the conference that we have wide participation. I'm going to give you a few more seconds, and if nobody wants to take the airtime, I'll pass it back to Charles to respond to the discussants. And it seems, Charles, this is your time to respond to the several.
Thank you very much, Albert, and thank you, Will and Kumar, for your thoughtful comments. I think you guys made a bunch of suggestions that are easily implementable, and we should actually look at all of those. So I don't have any dispute or complaints about any of those things that you mentioned, because I think we can look at all of those, and I think they're all useful to look at. So I think we do want to do all of those things, or virtually all of those things as well. And I really appreciate you guys thinking carefully about those kinds of things. And I agree with you that this distinction between positive and negative news, and this distinction between processing and anticipating future news is also an important thing. And we want to sort of do more to sort of investigate that. So, and I think I won't go into any great detail on responding to every single thing you said, but would love to get your slides and basically then maybe have a chance to follow up with you guys afterwards.